Hey, Josh, why don't you tell the people who you are?
I'm Josh Sheluk. I am Portfolio Manager and Chief Investment Officer at Verecan Capital Management.
Thank you. So, Josh, we recently did some trades, and what we're going to do here today is just go through the trade updates that we send out to our clients. So one of the things that we did was add to a position in Generac. What made you decide to add to that position?
So Generac is a position we've held for a while now, a bit over a year since we first initiated the position, and we've traded around that position a couple times during that holding period. Late last year, we actually trimmed our position in Generac because the price had reached a point and the position size had reached a point that we were a little bit more comfortable with a smaller position size in our portfolio. At this point, the price has actually decreased throughout this year, due mostly to issues that we think are transitory and not really directly related to the business of Generac. And the price reaching a point that it has now gives us a sufficient amount of confidence that the upside is there, that we should be increasing our position size again. So a lot of this, what I'm talking about, is risk management. We trim position sizes when they get too large or the upside is less, and we add to position sizes when the position is smaller or we feel that the upside is more.
And what does the future look like for Generac based on your analysis?
Well, we think it looks pretty positive, and if we didn't think so, we wouldn't be owning it as a business. But Generac is a business that many people are familiar with, and more so all the time, because they build generators, and the generators that they build and install are largely meant for residential spaces. And I hear more and more about people adding Generac generators to their house as a backup power supply. Now, that's not why we added to the position. The position was added through the analysis that we do and the projections of the future. We think that it has a good growth trajectory ahead of it. And part of the reason why the price has come down, the stock price has come down, is concerns around tariffs. But when we look through the financials of the business and the direction from the company, we see that their exposure to China specifically is something around 10% through their supplies, their cost of supplies, and they think they can get that down to about 5% in the near term. And there is some other international exposure, but largely their manufacturing is done in the US. So the business should be relatively immune or protected against any tariff action if this were to continue. And so we think that there's a particularly good time now to add to the business with, again, the upside and potentially overblown decrease in the value of the price of the stock.
And how does this move fit into our big picture game plan?
Well, we're always looking for opportunities, and we're always looking to manage around risks. So the opportunity here was that we thought that the upside was sufficiently higher than some other investment opportunities that were out there on the equity side or the stock side of our portfolio, that a larger position was warranted. And risk, to a certain extent, is about making sure that you have a sufficient, let's call it cushion or safety net, built into your projections. So we think that there's a material amount of upside with this business and the stock price. And even if we were a little bit overzealous with some of our projections, we think that there's still, in fact, upside to the stock price.
Moving on to the next trade, what drove the call to sell Cortland Credit Strategies?
Yeah, so Cortland is a private debt investor. So what they do is they make loans to private companies, primarily in Canada. Private businesses, just like public businesses, they need debt to thrive and to grow. And Cortland was responsible for extending short-term loans to those private businesses. The decision to sell really came down to one thing, is that we look through their portfolio on a regular basis, monthly, in fact, with Cortland, and their portfolio of loans, one loan had grown to a size within their portfolio that we are no longer comfortable with.
So there were specific risks that made you feel that now was the right time to hit exit?
Well, we don't exactly feel, we analyze. So in this sense, we were looking at the portfolio again on a monthly basis, and this one specific risk, the concentration of their portfolio, was significant enough that we felt that there was a risk to the position as a whole. And so that drove our analytical response to exit the position. And we are always doing this with all of our investments. If it's an investment in a fund that invests in other types of stocks or bonds or private loans in this scenario, we're always looking at their portfolios on a consistent basis to make sure that that portfolio is in line with our expectations for that investment, and that there's nothing from a risk perspective or a concentration perspective or a diversification perspective that is lacking from that position. So this was, again, an analytical view on their portfolio, and it was something that we've been monitoring for a while, several months actually. And we got to a point where we thought we've been patient enough with allowing Cortland to work through this concentration issue, and we weren't seeing the progress that we needed to see. So it was time to exit the position.
And where are we parking that cash now, and why?
Yeah, so with the proceeds from that sale, we've redirected it into two corporate bond investments that we already have within the portfolio. These were relatively small positions in our fixed income portfolio, about 2% weight each before we added to them. So we thought that these are positions that we've held for several years now, and we feel very confident and comfortable in their ability to add value through what can be potentially a challenging cycle coming up here with some economic strain. And on the corporate side of the portfolio, they tend to be, or are right now, a little bit more conservative. So if we do see some economic strain come through, we think these are corporate bond positions that have the potential to take advantage of that strain and add to positions at a more attractive price going forward.
Great. Well, Josh, thank you so much for your time. And if anyone has any questions or needs any more information, they can reach out to anyone on the team or go through the website. There's lots of information there.
You bet.
Thanks, Josh.